Welcome back to the Biff Mini Bites video series where we like to take 5 minutes to discuss each of the most important CFP exam topics. I'm Mike Long from the Boston Institute of Finance, and in this mini bite we are going to take a look at qualified distributions from Roth IRAs. And qualified distributions are the best type, aren't they? Yes. Because why? They are completely tax-free. So we want to meet the qualifications for qualified distributions. So let's take a look at this. All right, there are 2 levels of requirement for a qualified distribution. The first, very critical, it is an absolute requirement. No way to have a qualified distribution without this, and that is that the distribution must happen after a 5-year holding period. And I'm going to discuss this in more detail in a moment. And then secondly, the distribution must occur in one of the following circumstances: the account owner's death, account owner being disabled, first-time home purchase. Now that one's got a low lifetime maximum of only $10,000, but it still could be helpful to a first-time home purchaser. And then finally, the account owner attains age 59 and a half. Now, students sometimes get confused about this last one, age 59 and a half. And they feel that that's an absolute requirement as well, that you couldn't have a qualified distribution without being 59 and a half. That's simply not the case for Roth IRAs. It's just one of 4 possible circumstances to meet this second requirement. So if you think about it, once that 5-year holding period is satisfied, the account owner's death, disability, or first-time home purchase could happen at any age. And that means they don't have to be 59 and a half, right? If somebody's 30 years old and they have a Roth IRA and they've had it for 5 years and they want to take money out for a first-time home purchase, that is a qualified distribution. They've met both requirements, going to be tax-free, no penalty applies, and we move on. But let's take a closer look, though, at just exactly how that 5-year holding period works. Now, let's set a scenario up. We have a client, and the client makes a contribution to a Roth IRA. We'll say this is their first contribution. They make that contribution on April 1st of 2020. So we would naturally think then the 5-year holding period would end April 1st of 2025. But that's not how this works for the 5-year holding period clock. They actually will back that date up to January 1st, 2019, because that's the year for which the contribution was being made. So the actual holding period ends 5 years later, January 1st, 2024. And if you look at that closely, from the time the money actually went in, because it was then designated for the 2019 tax year, that period is only 3 years, 9 months. But the 5-year holding period has been satisfied. We can have a qualified distribution from that point on for one of those 4 circumstances I just went through. So I hope this gets you some points with your clients for understanding these important rules, and I really believe it'll get you some points on the national exam. I want to encourage you to watch the video that's the cousin to this one. There's another video on non-qualified distributions from Roth IRAs, and between those I think you'll be able to get all of the points on the exam for distributions from Roth IRAs. Thanks for listening. The full mini bite video series and many other really good study resources, including our very popular Biff Bites podcasts. You can find those at biffbites.com. We hope you check that out and use them, enjoy them. And as always, study on, my friends.